People ask what's happening by states. First question about Osceola County, Florida. Yes, in some areas, yes, it's down. Chat is open. Take a look, chat is open. You can put questions in chat. That's why we have a lot of subject to. A lot of sellers okay to sell subject to existing law. Osceola County, take a look, 4% down. It's close to, it's in Central Florida. Take a look. That's why if you'd like to sell, be ready, probably you have to decrease your price. Miami, let's see. Let's see. What's happening in Florida? In Miami, only 1.2 because demand is super high. Let's see Miami date. Let's see, 2.2. Take a look, another one. Austin. I see all your questions. San Francisco. San Francisco price is down as well. Let's see. What? Ah, it's different Austin. What state is it? New Mexico? Ah, Minnesota. Minnesota is still up. It's crazy. Take a look. Yes, Minnesota is up. Not so many investors. That's why. Florida in total 3.3. You see prices a little bit down. I see next California. California 0.8. It's stable, but some areas in California is going up. Let's see San Francisco. San Francisco is down. Put in comments, yes, in chat. What city would you like we can discuss? In San Francisco, California prices are up, they're not down. Take a look. You see? It was down in 24, 25. Since 2025, it's up. Demand, do you remember? Artificial intelligence, a lot of jobs, that's why it's up. Okay, subscribe, give like to this video. Yes, put in chat what city. You said another one? Los Angeles? Let's see, Los Angeles. What's happening? And yes, we provide all type of loans, the cheapest options. That's why subscribe, give like to this video. Yes, we have realtors, everybody, everywhere, for sale by owner, a lot of stuff. Okay, that's why subscribe, give like to this video. And this is free information. What's happened in Los Angeles? In Los Angeles, 0.9. You see, it's still stable. It's not crazy down. Next, Austin. Austin is down. If you want to buy properties in Austin, right now it's perfect time. Austin, Texas. Yes, rates are, I see your questions in chat. Yes, rates are cheaper than banks. Austin, you see prices 5% down. It's crazy. Take a look. Prices in Austin are down. That's why if you want to buy right now, it's a good time to buy. You see? Next question, I see Jacksonville. What's happening to Jacksonville? Take a look. I will show you. Jacksonville 2.2% down. You see some correction. Again, put in chat, yes, what city would you like we discuss it? Yes, put in in chat. We have chat, you can put your questions. Next, New York. New York is up, never goes down. Why? Because demand is high. Not so many brand new constructions. You see, New York prices up. Prices are down in central Florida, in central Texas, because a lot of brand new constructions. New York is up. Next, Texas in general. Take a look, I will show you. Yeah, subscribe, give like to this video. We have a lot of useful information. And you can buy a house without even down payment. We have a lot of programs, especially for first-time home buyers. In Texas, in general, prices 1.9% down. Not much, but some areas literally is super down. Next, Arizona. I see your questions. Arizona, let's see. Easy. Arizona 1.6% down. Let's see. Actually, you see it's stable and a little bit down, not much. That's why it's not big deal. You see? Another one, Utah. Utah was in demand during COVID. Do you remember after COVID? But in Utah, price is up. It's good. If you invest in Utah, it's very good investment. Okay, that's why next video we discuss how to buy subject to existing loans, seller financing. That's why subscribe, give like to this video, and what city would you like? We can see and discuss it. I see Los Angeles. Let's see Los Angeles. Almost 1%. Not much. Not huge decrease. But yes, Marina Del Rey, let's see, is down. Marina Del Rey, it's in Los Angeles. 2.5%. And take a look. Wow, it's a huge loss. Do you know the reason? Demand is down. Mar Vista is up. Let me show you Mar Vista, Los Angeles. Yes, subscribe, give like to this video. I see all your questions. Put in chat. Do you see chat? Put them. 5.4%. Mar Vista has a lot of technology company and everything is up. Okay, so subscribe, give like. Do you see chat? And yes, I'm waiting. What next city? San Antonio is down as well. If you want to buy, yes, we have a lot of program for first-time buyers. Take a look. San Antonio 2.1. Yes, prices are down. Even Orlando a little bit down. Yes. Next, Pennsylvania. Yes, I take everything from chat. Put questions there. 2.4%. Pennsylvania is not down. Housing market is up. Another one, Indiana. Up 3%. Take a look. Demand is high. But a lot of foreclosures as well. Put in comments why it's like this. And what's happening in Florida? Because insurance is so high, that's why prices are down. Because not everybody can afford it. Take a look, 3% down in Florida. You can see. You see? Again, I see a question about. I see. Winter Park, Florida. Let me show you Winter Park. Only 1% down, not big. Because winter Florida has good areas. Next candle. I see your question. Candle, Florida. What is it? Why it's not here? Oh, candle. Why it's not here? Do you know? Put in comments why it's like this. Why candle is not there? Because candle is close to Miami. Why it's not? And let's see real estate market update. Put in comments, yes, what city would you like? I see all your questions. Yes. And prices will go down, yes, in some areas. Let's see.
Buyer's market for real estate. Sellers are watching their homes linger on the market longer. And that means you now have the leverage to pick up great deals and to negotiate hard. This may not be the trend you're hearing about in the headlines, but the data does support it. And now is the time to take advantage before everyone else gets the message. I'll share how I discovered this crucial recent shift, which regions are seeing the most positive trends, and what you can do about it all in the Bigger Pockets June housing market update. Hey everyone, it's Dave. Welcome to the Bigger Pockets podcast. Today on the show, we are doing our June housing market update, and this is going to be a great episode. I think you're going to be pleasantly surprised by some of the information that I'm going to be sharing with you. I know a lot of the mainstream headlines and narrative about the housing market is overwhelmingly negative, but I actually think there are some encouraging trends that real estate investors should be taking note of and should be using to guide your investing decisions. So I'm going to start the episode today by laying out the big, important stuff up front, what's going on a national level, the kind of stuff that impacts everyone. But then we're going to go into a regional update where I'm going to share some trends that are going on across the country to help guide your decision-making on your specific portfolio and your next deal. Then we'll move on to our risk report, something we do every month where we talk about potential stress in the housing market, because that could create risk in your portfolio or it could create a national crash. So we're going to keep our eye on what's going on there. And then we'll end the episode by talking about what this means for you specifically. Let's get into it. So first up, let's talk national big picture stuff going on in the housing market. The headline I want you all to take home today is it's actually doing okay. I know that's not what everyone's saying, but that is actually correct. You heard it right. The market is doing okay. Is it great? No. Is it the healthy kind of market we wish we had, something back in the 2010s? No. But is it falling apart? Is something disastrous happening in the housing market? Absolutely not. That is not happening by a long shot. Instead, the big picture in the housing market right now is that we are in a classic buyer's market, which does come with risk, but also means a lot of opportunity for people who know what to look for and who understand what's actually going on. So that's the headline, but I'm going to share with you some data to back up what I'm saying here. Prices on a national basis, year over year, which is how we should be looking at housing market data, are basically flat. The Case-Shiller, which is really good data, lags a little bit, but that has us at less than 1% growth year over year in terms of prices, at 0.7%. And flat pricing is exactly why I've been calling the period we're in right now the Great Stall, because we're in all of the market conditions that I've been talking about for years that are going to stall out home prices are happening. And flat prices is kind of exactly in line with my headline, right? Is it the best thing ever to happen for real estate investors? No, of course not. We're not getting the appreciation we saw for a decade or more, but it's also not falling apart, despite what people are saying. So prices pretty stable, and stable for real estate investors is good. Same kind of story with inventory. And inventory is a super important metric. It's actually, personally, I care more about what's going on in inventory trends week to week, month to month than prices. I know prices are that sexy thing everyone wants to look at. But inventory is such an important number because it helps us understand the balance between supply and demand in the housing market. And when inventory is moving rapidly, that means a big shift in the whole market might be coming. And what's happening with inventory right now is it's also really flat. We actually see that it's down 1% year over year, according to Housing Wire. And the fact that it's flat, and actually a little bit down, is crucially important. Flat inventory tells us that the balance between supply and demand is relatively stable. We are not all of a sudden seeing tons of people leave the market as buyers. We're not all of a sudden seeing a ton of sellers enter the market and flooding the market with inventory, which can push down prices. We're not seeing any of that. In fact, what we are seeing is a great stall. We're seeing inventory level out. And although there is opportunity for inventory to get better, in my opinion, again, this means stability. We are not seeing wild swings in inventory. And for investors, stability is a good thing. The other thing you should take away from this is that inventory being down a little bit is further proof the crash is highly likely. If the crash was going to come, we would see inventory going up. It will most certainly happen, either because the market was being flooded with homes or demand was leaving the market, but inventory is stable, which means supply and demand dynamics and prices are likely going to be relatively stable for the foreseeable future. And there's other data that supports this too. It is not just the inventory number. Trust me, I look at everything, and I'll just share with you quickly two other things that give me conviction about this, that the market is stable. You see that going up rapidly, but instead, we're seeing a few more people list their home for sale, but nothing crazy, and it's really, in a historical context, not really that high. And then secondly, perhaps I think most importantly, and most encouragingly, demand, the amount of people who want to buy homes is actually doing pretty well. It's actually up. We're seeing more people entering the market right now than we did a year ago. I know that is contrary to the narrative that is being projected about the housing market, but listen to this. Pending sales, the actual amount of transactions on real estate in any given week, up 17% year over year. More people are buying houses right now than there were a year ago. So all these people saying that buyers are running away from the market, it's just not true. It is patently false. You can look this up anywhere. That is not true. We also see this backed up in mortgage purchase applications. The number of people who are going to their bank and asking a loan to go out and buy a new home, not refinance, go out and buy a new home, that is also up year over year. So don't let anyone tell you that demand is gone. Is it good in any historical context? No, it is not the best demand we've ever seen. It's actually pretty low. But the thing I'm trying to convey here is that even though we're not in a great market, it's not getting worse. It's not really changing all that much right now. I think people are getting used to where we're at. Instead of sitting on the sidelines and waiting for mortgage rates to come down, I think people have accepted the new reality that we're in the housing market. And although I still believe in the great stall, and this is going to take a while, probably years for it to get back to a healthy level, the stability that we're achieving makes decision-making for investors a whole lot easier. And we're going to talk about that more later in the episode, but that's the main thing that the data is telling me. Before we move on to the regional stuff that I want to talk about, just two other things that I think are notable in terms of the national market that are also encouraging for investors. Number one is that days on market is going up. This, again, similar to inventory, helps us understand the balance between supply and demand in the market, but it also helps us understand who has the negotiating leverage when you're going out and transacting on a property. When days on market, which is just a measurement of how long, it's very literal, how long that a property sits on the market before it's put under contract, when those are really low, the seller has all the power, right? Because that indicates that buyers are bidding on anything that hits the MLS and that sellers have a lot of negotiating power. When days on market go up, like they are right now, that tells us that buyers are gaining power. And as a real estate investor, that is something you should be taking note of. Because that means that when you approach a new deal in a stabilizing market, you can be more aggressive about what you bid. And by aggressive, I don't mean bidding high. You can be aggressive in your lowballing. So make sure I'm not paying more. I mean, you can be bold in the kinds of offers that you are willing to write in a market with days on market rising. And that's exactly what's happening. And to back that up, last piece of data here I'll share is that according to Redfin, right now, there is actually 500,000 more sellers in the market than there are buyers. And this is exactly why days on market is going up. And this is exactly the kind of opportunity that real estate investors should be excited about. This is what tells us we are in a full-on buyer's market. Now, buyer's market does not mean everything's great. You should go out and buy everything. It absolutely does not mean that. It means that you, as a buyer, have the negotiating power. You have leverage. You have the ability to be picky and to negotiate and to pick only the best assets to add to your portfolio and to be patient. The combination of a more stable market but better negotiating leverage is an opportunity investors really should be taking advantage of. And to me, is good news. The market does not need to be perfect. Stability and leverage is a great place to start building your strategy from. And after the break, I'm going to share some regional trends and how you should go about looking for your next deal depending on what's going on in your region. We'll get to that right after this quick break. Stick with us. You know what changed the way I invest? Realizing that scaling rentals shouldn't mean creating more work for yourself. If you're trying to build that kind of system, Baseline is giving away $10,000 to help investors build rentals that run themselves. I own and manage dozens of properties. I travel a lot, and I still work a W-2 job. And there was a point where I was checking multiple bank accounts, chasing rents, and updating spreadsheets just trying to stay organized. Even on vacation, I was constantly checking if rent came in. Now, everything runs through Baseline. It's bigger pockets of...
Let's see what's happening with multifamily. Yes, subscribe, give like.
Multifamily housing has been crashing over the last couple of years, but are we close to the bottom now? Today we sit down with letsbuyahouse, who operates a fund in real estate. He's here to tell us what he's seeing in the marketplace right now, and is this a good time to buy?
In 2026 today, there is $864 billion of commercial real estate maturing this year. A quarter of that is in multifamily. Property values have dropped between 20 and 40% depending on what market. If the real estate market cycle was a clock, and 12 o'clock was top of the market, and 6 o'clock was the bottom of the market. So if we want to look at what time is it today, of course we're much closer to 6 o'clock than we are to 12 o'clock. Now, is it 5 o'clock or is it 7 o'clock? That's the question.
I'm Siamak, and this is Market Insider. August, it's great to have you. Welcome.
Thanks for having me. Looking forward to this.
We want to talk to you about the housing market and the real estate space. You have a fund and you're investing in multifamily and commercial, right? Can you tell us what's going on in the market? What are you seeing out there right now?
Yeah, of course. I mean, to talk about the market today, we'll take a step back and see, what made us get to this point. The great financial crisis, the subprime mortgage crisis in 2008 resulted in the U.S. economy almost collapsing, many banks failures and so on. And from that moment, the economy went through a recovery phase after that major recession, same thing with the housing market. And the bottom of the market came really in 2011. That's when prices actually started going up. So we were in recession for a few years. But from there, the market went on a bull run, both commercial real estate and the residential real estate market. It went on a bull run all the way up to 2019. But by 2019, you were already seeing cracks within the market. It's seeing that we were in the mania phase of the real estate cycle because real estate continuously goes through these cycles. So it was already somewhat frothy, the market as is known. But soon after that, as you're aware, COVID came, this cataclysmic event, the pandemic, and it restarted everything. So central banks around the world had to lower interest rates to keep the economy going, and they had to print a lot of money so people didn't have to go to work and get sick. And it resulted in inflation because people had abundance of cash, started spending a lot of money. So inflation in the US went up to 9%. And from there, some say that Fed was too late to start increasing rates, but the Fed started going on a tightening cycle, started increasing rates. But from there, when interest rates were low, before the Fed started increasing rates, 2020, 2021, a lot of acquisition groups, people that buy already existing properties in the commercial real estate space, and developers started borrowing a lot of cheap debt and acquiring a lot of deals and started building a lot of deals. So a lot of deals came online, a lot of deals transacted. So you already had this inflated market, real estate market by 2019 because of that bull run from 2011 all the way to 2019. But as a result of cheap debt, that market even amplified.
So was it multifamily or
multifamily, other asset classes, for example, office space was an asset class under the commercial real estate umbrella, which was already in a difficult position because people were going to work, lockdowns and what have you. So, but yeah, every other asset class was booming, multifamily as well. So deals were trading at 3 cap. So cap rate is a measuring stick for commercial real estate. Is what type of yield you're getting if you buy the property cash. So 80s deals were trading at a 3 cap, where historically they're trading at a 6 cap. So people are paying
double the price.
Double the price, pretty much, exactly.
Double the normal
exactly.
price.
Historical averages. The mania market went into this other amplified market, but when the Fed started tightening, going on a tightening cycle and increasing rates, it really slowed everything down and created some distress in the space, which we're still facing today. In 2026 today, there is $864 billion of commercial real estate maturing this year. A quarter of that is in multifamily.
So the loans are maturing, and then so people have to get new loans with double interest rates. How does that?
Exactly. Not only to get, you have to, so commercial loans, unlike residential loans in the U.S. that are much shorter term. Residential terms are around 30 years. Commercial loans are around 5 years. You can get it for 3, you can get it for 7, but the average is around 5 years. So every 5 years, they have to renew those mortgages. So anybody who bought anything at 2021, now they have to, time has come for them to renew those rates. So not only rates have gone up, but they also have issues with oversupply because of so much development that went on. So much supply came online. And when supply comes online, it has a downward effect on rents. It has a downward effect on occupancy. And also a lot of groups have to provide concessions for tenants who are coming in. So free month of rent, free couple months of rent, other types of concessions to bring in tenants. And that has an effect on prices, and effects on rent. So valuations have dropped. So when someone has bought a piece of multifamily property and they paid a certain price for it, obviously a very high price at a 3 or 4 cap. Today, the cap rates have expanded, so valuations have come down, but their interest rates have gone up, so rents have come down. So overall, the valuations are so low, they're in most cases lower than even their no price, their mortgage amount that they have borrowed. So unlike 2008, a lot of lenders and banks are working with borrowers to get them through this phase that we're in currently. But now that has gone on for a few years already because the Fed went on a tightening cycle starting from 2022. So they were just pushing the can down the road, but now they have started to call a lot of these loans and foreclose on a lot of properties. So we're seeing in our space a lot of deals coming online that are what we call REOs, real estate that's owned by the banks, and they're either working with the current owner to, they're amicable in some ways, or working together instead of going through the foreclosure process, and they're trying to sell the property. But in most cases, they're either selling it at no price or even below that. So that's what we're facing right now with the commercial real estate space. But on the residential side as well, home prices from 2020 have gone up 35% nationwide. And mortgage rates have also gone up. So in 2020, prior to 2020, it was cheaper to own on a median home price relative to a median price for an apartment unit. It was cheaper to own than it was to rent. Today, it's actually $1,500 more expensive per month to own than to rent. So it's cheaper to rent today. So because of those increased mortgage rates and mortgage amounts that people have to pay, a lot of people are having to rent today.
So the price has gone up, the rates have gone up,
Exactly.
everything has gone up.
Exactly.
So you're seeing two different markets essentially from what you're saying. The multifamily, it's crashed, but the single family hasn't moved. What do you think about the single family market?
Single family, I mean, the consumer is still there. The demand is there. The issue is that the mortgage rate. So it's not about demand. It's about can people afford to buy that starter home. So starter home, the $430,000 home in the U.S. Can they afford that home? But today the answer is no because of the increase and elevated mortgage rates. So the hope, and that's why you can hear the Trump administration trying to work with the Fed to reduce rates, and they pretty much kicked out the previous Fed chair, Jerome Powell, and they brought in a new guy, hoping for those rates to come down. So therefore, they're going to be there more. But as a result of inflation still being sticky, inflation is at 3.6%. The Fed wants inflation at around 2.5%. So they can't reduce rates right now. So overall, as far as fundamentals that exist for housing and demand persists. However, because of elevated mortgage rates, people are tending to rent today and waiting for those rates to come down, and then they can get back into the market. You also have issues when it comes to immigration. Immigration is a big push when it comes to housing demand, and the Trump administration is very much against illegal immigration, but also legal immigration also as well. So if you compare Trump's first term to Biden's term, the immigration really dropped in Trump's term and then went up back in Biden's term, and then now it's dropped again as a result of policy and other means.
So what are you seeing right now in the multifamily? You said some banks are putting the inventory in the market. They're essentially foreclosing these buildings. It's not the individual homes that are getting foreclosed. It's like apartment buildings getting foreclosed. How would the pricing look like for these things? Is it cut in half? Or is it less than half?
Yeah, just quickly, you touched on the residential single family as well. Now, in 2008, when that the subprime mortgage crisis resulted in a lot of distress within that space, we're not seeing that currently in the single family space because a lot of mortgages that were secured in 2020, 2021. A lot of properties that were purchased, so they're good for the next 30 years. They're actually
they're
in a very good position because the rates are low. They bought the homes on a perfect timing, so those mortgages are fine. Now, the same thing, the same time period, 2020, 2021, even 2022, when early 2022, when commercial real estate properties were purchased multifamily, those mortgages are now maturing and the valuations have dropped, like we touched on earlier. So there's a lot of distress in that space. So yes, property values have dropped between 20 and 40% depending on what market. Like a market like Jacksonville, multifamily values have dropped 40%. In markets like San Antonio and Austin, property values have dropped by 20%. That's really where we are currently in the multifamily space. But also, any down market creates an opportunity as well.
Do you think it's going to go a lot more lower than where it is, or do you think it's hitting the bottom?
Yeah, I tend not to try to predict the market bottom or market top, but we know that if the current, if the market, real estate market cycle was a clock, and 12 o'clock was top of the market, and 6 o'clock was the bottom of the market, and top of the market is what we saw in 2019. There's mania, there's multiple offers, people are putting down non-refundable deposits, they're purchasing at a very low cap rates. That's top of the market. Bottom of the market is recession, people are walking away from their deposits, there's a lot of foreclosures. So if we want to look at what time is it today, of course we're much closer to 6 o'clock than we are to 12 o'clock. Now, is it 5 o'clock or is it 7 o'clock? That's the question. Have we hit the bottom yet? Have we not? And when I touched on earlier about commercial loans maturing this year, we still got close to $1 trillion of commercial loans maturing. So there could be a fact that the bottom market is still not here, that we still haven't seen the bottom. But as an investment group, as an investor, when you want to get into the market and you're near bottom or you just past the bottom, it doesn't really make that much changes because if the market's corrected already 20 to 40% and you're going in there and you're able to put the right debt, you're able to put fixed debt for a 5-year term and you have the right thesis and right business plan, you should be in a good position even if the market drops another 5 or 10%.
So when you go to these deals with the banks, is there a lot of competition? Are there a lot of buyers that you're competing with, or is it the buyers don't have the appetite to be there?
There are still a lot of buyers. There's still a lot of demand. A lot of larger investment groups that raise capital and have access to a lot of equity. They've been in a buying mood now for at least a couple of years. It's not a situation where we're sitting on the sideline from 2022 to 2024, approximately mid-2023.
Let's discuss foreclosure
Welcome everyone,
process.
Tony Martinez here of the Real Estate Advancement Institute, home of the CDPE,
Yes.
Certified Distressed Property Expert.
If
and
you
now
have
also
foreclosure,
resident
contact
specialist
us.
Certification. Thank you so much
We
for
can
joining me
help
today.
you.
I'm so excited about once again having the one and only Melly right as a featured guest. Melly, last time it was April of 2025 that we got together. So you haven't been doing anything since then, have you?
No, nothing at all. No.
Let's go through this. I want this to be all about you, and I want this to be about the group asking questions and everything else. But there's probably folks on here, or we'll watch this replay later on, that don't exactly know why you're here. So why don't you tell them a little bit about yourself?
Sure. So I started a mortgage back in 2006, just in time to experience the great financial crisis at a top 5 mortgage originator and servicer. And, I got an education very quickly and what was going on. I was in corporate finance. By the end of it, they had me manage their default operation because they were in serious trouble. At the time, I had over 65,000 foreclosures in my portfolio, believe it or not. So I spent a year on the road actually going to all the default firms. And because, I'm a big believer that the only way you really move anything is by getting into the details and the only way you really understand it. And so that's what I did. I got into the dirty details. After that, I tried to fix the industry, tried to create some technology to fix the industry. And then I have an academic background. One of my presidents asked me, when are rates going to rise? That was his question because we were, as everyone can remember, we were going through this insane refinance boom. And that's when I really started getting back into macroeconomics, which is something I had studied kind of in college in graduate school. And I realized, having done that,
Yes.
all my experience together
Put all
that
questions
everybody
in
in
the
the media
comments.
was getting the story wrong. And mind you, I didn't think we'd have any trouble in mortgage back then because I believed kind of the credit quality
Okay.
gospel singing that everyone was doing. And I also knew that
Subscribe,
I had been
give
part
like
of,
to this
trying to
video.
change things. What I failed to remember is that every time I really tried to change things at those organizations, they always kind of stopped. It was just too much to do the right thing, honestly. But the difference now, a big difference now from then is that the government is actually sponsoring the subprime. And FHA, is, I'm sure a lot of you know, has really doubled since back then. And so anyway, I have been, once I realized that people in the media were getting the story wrong and the data was wrong, I went on the road and I continued to travel across the country, just looking at local markets. I track 86 markets each month for sales price and inventory, and I talk about the housing market and what's going on. And so, especially default. That was a little long. Sorry, Tony.
No, it definitely, I mean, you definitely know what you're talking about. You're bringing a lot of experience and everything to the equation. And one of the things that I know that you're famous for is your road trips, right? And you took one recently, right? You went to a few places. Tell us about that.
Yeah, so I spent about 2.5 weeks, I went down to Florida again. I went for a housing policy conference. Could not believe my ears. Everybody was so bought into the inventory shortage. But, in Florida, I did some site visits and, everyone was still lying. You would challenge, I did a secret shopper visit in Lakewood Ranch, which is going to go down in history books as one of the worst disasters ever, and disaster of this cycle. And they're just, when you try to, counter with facts like, oh, did you hear, Florida gained 22,000 people net last year? Oh no, tons of people are moving here. It was just lies. But, it confirmed, again, I saw all the new build, all the inventory, et cetera. I also went up, the East Coast, what you have there is very different. You have a lot of vacancy because you have a lot of older Americans that live there who are aging out or who have already died. And why we don't, and when I'm talking to your group, Tony, I have to remember there are people that actually know what I'm saying. But, if you know probate, depending on where you are, it can take a long time. And so like recently I was just at an auction here in Tennessee, that property had been in probate for 3 years. And so what you're seeing all over the Northeast is increases in those pre-probate notices, like when you get a dead flag on the credit account. So I just confirmed that not only is that part of it, but the speculation is there in the Northeast as well. And then I went over to the Midwest, which, for those of you that follow the housing market, you'll know it's been kind of the last holdout of strength, largely because investors could still afford to buy homes there in cash flow. And there was a lot of speculation around these data centers, that Intel plant outside of Columbus and New Albany. And so I stopped there, Tony. Again, saw a ton of speculation, but also I saw what's holding up our entire economy. We know this, we've heard this about the data centers, about AI, but there are 25,000 in New Albany. And, but the big problem is they don't have the power that they need for these data centers to be up and running. They just simply do not have it. And in fact, in that location in New Albany, they had been working on the power grid since 2010. So they had done everything they can to shore it up, but you've got a meta data center there that's just simply not going to be able to get up and running. And so you have to think about what happens when these 25,000 people go home. What happens to our economy? And that's just one location. And Tony, I'm announcing this probably I'll be doing some data center trips here shortly as well, because again, so much of the speculation was around these data centers. So, when people ask me, what did you learn? I learned to stop doubting myself. What'll happen is you get back from these trips and you're like, did I really see what I saw? Like, can it be as bad as I think? And then you just get back on the road and you're like, yeah, it is really that bad.
Wow. Well, one of the questions I asked you last year, and I waited a little bit to ask it, but I think it's time to ask it again. I asked the question, will it be as bad as the great financial crisis? And it's seared in my brain, your response as well. I think it's going to be worse.
Yes.
Well, it's been a year plus. Has your opinion changed on that at all?
No. And it's just, so the thing is, it's just, this takes an inordinate amount of time. And with the amount of government intervention we've had, Tony, that's what everyone gets so wrong about this crisis. It's like you basically had twice the intervention before, anybody went delinquent, basically, or went, so it is just, I'm watching these FHA partial claim trial plans fail left, right, and center. And so everybody probably remembers that they put those guardrails on in October. And we talked in April. I can't remember if they had just announced that they were going to put those guardrails on, because that's when they had announced it. We knew it was going to be October, but then you have to know servicing. You have to understand that even though they went on in October, the way the trial plans work, it's going to take another year to 18 months for us to really start seeing that delinquency tick up. Right. And it's already started. We're coming off the floor. I think the latest report from ATTOM was 14% year over year, and the month before that, 26%. And so it's happening. But what the servicers will do is they'll put you in that payment, that partial claim. You'll have to pay 3 trial payments, but they'll wait until you're done with that, the whole 3 months to pass, before they even start looking at you for foreclosure referral. And then there's still, believe it or not, and this sure just going to make everybody angry, but there's still some forbearance left. They didn't count the COVID forbearance against your total forbearance that you can have. And so really, we're going to see, although we're definitely seeing delinquency tick up, and I want to talk about what I'm seeing in the prime books too, we're not going to see it really start to materialize till Q4, Q1. And so will the foreclosure crisis, will it be worse? Yes, somebody knows about that New Albany, those data centers. The foreclosure crisis, it might not get to the point it did last time, although I think it will, because they might intervene before, you might have the government buying up these homes. Because if everybody remembers, in 2012, the institutional investors are what really slowed the skid, right? That's what really got us out of the crisis. It wasn't anything else. It certainly wasn't the loan modifications. That did not help. But they stopped it by buying up the homes to do long-term rental. Well, who's going to be the buyer now? Because the institutionals are fire selling, and I met with them in September. yeah, I can talk on commercial foreclosures as well. But let me tell you what I'm seeing in the prime books, because this is new breaking information, Tony. For those that are in default, you'll know that. Oh, I've been to San Antonio. Okay, I gotta stop reading the chat. I have been to San Antonio multiple times. I got a YouTube video you should check out. But what's happening is there's a seasonality to delinquency, right? You know, if you're in the industry, you know this. You know that delinquency typically peaks in December, you know, because of Christmas and things like that. But then you have tax refunds and you have bonus payouts. And if everybody remembers, you're supposed to have big tax refunds. But guess what? We are not seeing delinquency go down. And it's important where we're actually seeing it increase. It's in the Fannie Mae and Freddie Mac books, which should be pristine. They should be pristine. And so, you know, you've got FHA in there too, but for Fannie and Freddie to pop up here, that's a big deal. And so they're joining the party. You know, the layoffs are finally feeding through the system. Yeah. Those increased gas prices, you know, food inflation, I mean, and property taxes and insurance. I mean, Tony, I was just doing a default review for one of my clients. And one thing that I do is I look at their big escrow advances, like just make sure, like, what's going on, you know. Oh my word, I saw someone whose payment went up over $1,200. I mean, that's just insane. Just think of yourself sitting at home and suddenly you're told, I've got to pay $1,200 more a month on my mortgage. Like, that's massive impact. And it was on a $500,000 loan, okay? It's not even a huge house. So, you know, the consumer is under great stress.
Well, back in 2008, what started everything were subprime loans.
Sure. Yep.
Right. And then we went into the Great Recession, and next thing you know, A-paper loans.
It's A-paper. That's right. That's right.
Because people were just out of work, right?
That's right.
This time around, it was, you know, I think FHA mortgages are the new subprime.
They are. I call them government subprime all the time.
And the default rate on FHA
oh my gosh,
is scary. I mean, we're talking about maybe
13%.
13%. And this is also factoring in all the intervention, like you said, you know, all the stuff that was going on, because we had Don Comiskey on, and he talked about these scenarios of people were getting 14 partial claim mortgages.
14, right.
Yeah, insane. And
insanity.
I think that's gone away or start to go away. And then I'm also concerned about VA, because for a while, the government was buying up these loans and acting as the bank for these veterans, and they're no longer doing that either. So we're going to see FHA. I see no reason to see that FHA is going to start going down anytime soon.
No.
And then VA is going to start to go up. And now you're scared because you're talking about the A-paper people, because they're conventional, right? They're supposed to be pristine. And now, people what? The economy is what it is. And
that's right.
I take every single report that comes out with a grain of salt.
Yeah.
I look at this and I go, okay. And I think everybody on this call knows somebody that's either been laid off or about to be laid off or they themselves are laid off. I have 2 agents on my team that work for Spirit. You know, and look what happened there. And I think more and more of these are going to happen. So you know, are you seeing?
Okay, let's continue.
All over again in terms of the areas of the country
Discuss what's happening
being impacted.
Yeah, I mean, it's so sad. I mean, it's just like said. I spent that whole year.
So, foreclosure income, and let's discuss what's happening in different areas. I see your questions about Miami. Yes, put in comments what city you would like to see, and we discuss it. Don't forget subscribe, give like to this video. Miami slight decrease, 1.2%, not much. The whole Miami-Dade is not going down much. Miami-Dade County. Miami-Dade County only 2.2%. I see your question, Brickell. Brickell, Miami. $3.6. Take a look. Not super much, but the level of 2022. Okay, subscribe, give like to this video. We see you next video. See you. Bye.